Good morning and welcome to Opening Bell on Money Control. I am Nandita Khemka, and of course it's a Tuesday morning. Cues are pretty mixed. Remember, we have a two-day FOMC meeting that's kick-starting today, and expectations are that the Fed will hold fire when it comes to interest rates, but it's a commentary. Or it's the Fed chairperson's commentary that will take center stage, and investors will look for clues as to how the US economy is faring and what the outlook really looks like going forward. But 24,500, that has been a resistance zone for the Nifty. Whether or not we can close above that level decisively, and what are the next levels to watch out for on the Nifty and Nifty Bank, we will take stock of that with our technical analyst on the show. We'll also be talking about all the stocks that are in focus, the likes of Tata Motors, Coforge that reported numbers post market hours, Indian hotels, and a lot of numbers that will be coming out today, the likes of Polycab, BSE, all these Paytm, all these companies will be reporting numbers today. So yes, an action-packed day in store, lots of numbers coming out, and of course we'll see which way the market really heads from here. Given the fact that we've seen a resumption in the up move after a 2 to 3 session consolidation in the market. But of course, all your stock related queries will also be in focus. Keep them coming in on our live feed. We'll try and get them addressed as well. But before we move any further, take a look at the top headlines at this hour. Wall Street kickstarts the week on a weak note. The S&P 500 snaps its 9-day winning streak amid lingering uncertainty over tariff agreements. Investors are now focused on the upcoming Federal Reserve Fed decision, the first since President Donald Trump announced reciprocal tariffs in early April. Asian markets open largely higher as investors assess trade developments between US and partner countries in the Asia-Pacific region. The GIFT Nifty is indicating a mildly higher start for our markets. Oil prices hold steady near 4-year lows as OPEC Plus accelerates its output hikes, even though demand outlook remains uncertain. Meanwhile, gold prices edge higher, driven by a weaker dollar and safe haven demand. And in key earnings today, Godrej Consumer is expected to report a 7% growth in revenue with 4 to 5% domestic volume growth. MGL is likely to report a healthy set of numbers, while the street is expecting a weak performance from HPCL. Polycab and BSE are the other numbers to keep an eye out for today. Well then, taking a look at the cues for trade before we bring on board our technical expert for today. Markets, of course, ended at the highest closing level of 2025. Nifty ended above that 24,450 mark, but 24,500 we haven't really been able to sustain above that on a closing basis. How crucial is that? We will pose that question to our experts. The big gains were seen in the broader end of the markets, with the mid-cap index surging as much as 2%. The market breadth was firmly in favor of advances yesterday. Advance decline ratio was almost 3:1. Nifty Bank, has been witnessing some bit of an underperformance in the last few sessions, but yesterday SBI, Kotak, these two stocks were reacting to their earnings, and which is why the Nifty Bank index ended the day in the red below that 55,000 mark. Crude sensitives saw big moves yesterday. Upstream oil companies were, on the back foot, but downstream companies like HPCL, IOCL, BPCL saw good gains. Paint companies, airline companies also saw good gains as crude fell below, Brent crude fell below that $60 per barrel mark. Metals managed to snap out of a 3-day losing streak. The put call ratio rose to 0.97 from 0.91 in the previous session. And if you look at the stocks in the F&O ban, there has been a new entrant in the F&O ban list, that's Manappuram Finance. RBL Bank continues to be in F&O ban, but no exits, so to say, from the ban list. FIIs remain net buyers. I think it's the 12th or 13th straight session that foreign investors have remained buyers in the Indian market. 498 crore rupees worth of stocks bought in the cash market. DIIs were net buyers to the tune of almost 2,800 crore rupees. On that note, let me bring on board our technical guest for today. Joining me is Jatin Gedia, technical research analyst at Mirae Asset Sharekhan. Jatin, lovely to be chatting with you this morning, but 24,500 seems to be a stubborn resistance zone for the Nifty. Any possibility of that getting taken out on a closing basis in the next couple of sessions?
Yeah, good morning, everyone. Yeah, so as rightly pointed out, 24,500 coincides with the 61.8% retracement level of the entire September to April decline that the Nifty has seen. So it's quite a crucial level. 24,500, 24,550 remains a pivotal point, and that is where the Nifty has been consolidating since last. You can say a couple of weeks post that 12% move from the panic low of 21,743. Now, what on the weekly options chain, what we can see is that 24 500 short straddle is being created. Basically, what that means is that the option writers are betting that 24 500 around 200 points here and there, the Nifty is likely to consolidate between this range for this weekly expiry. So we believe that there has been a improvement in the PCR from the previous trading session. So that is a bullish stance by the option writers. However, we don't see major upside immediately because the straddle premium is around 190 to 200 points of 24,500. So on the upside, we can see resistance at 24,700. If that is breached, so 24,700 is the level to watch out for. If that is breached, then we can expect a sharp short covering towards 25,000. So what we are closely watching out for today's trading session, if we see unwinding of the 24 500 strike call option. So if the call writers start to unwind, then we can expect the Nifty to start inching higher over the next couple of trading sessions. So I believe that overall, more or less, it's going to be a sideways kind of a range bound price action in the case of Nifty. However, if we see unwinding, then we can expect sharp short covering in the Nifty. So on the downside, 24,200 is the level, is the crucial support level. So if that is breached, then the overall structure, shall uh, range. It will be a range bound manner. So 24,200 is the level to watch out for on the downside. 24,700 is the level to watch out for on the upside.
Okay, those are the levels to watch out for. 24,700 on the upside, and if there is a short covering rally, then who knows, 25,000 maybe on the cards as well. But what about the Nifty Bank Index? Of course, this leg of up move was being led by the Nifty Bank Index, hit fresh highs of 56,000 and beyond. But since then, it has come under some bit of selling pressure. We've seen consolidation, and now with banking earnings also trickling in, and the likes of SBI, Kotak Mahindra Bank were reacting to earnings. So we have seen the Nifty Bank Index, on the back foot over the last few sessions, so to say. But what is the floor that you're working with when it comes to the Nifty Bank Index? It's at 54,900 currently.
Yeah, see, in the case of Bank Nifty was the leader of the rally that we saw, and it's very obvious that post hitting an all-time high, the Bank Nifty consolidates or takes a backseat because sectoral rotation is also likely in the next couple of weeks. We have seen the Bank Nifty leading. Now it's taken a little back foot or has entered a consolidation phase. Now this consolidation phase is taking form of a triangle pattern on the daily charts. The range has been narrowing, so it's a textbook triangle pattern that is forming on the daily charts. And what we are expecting is a breakout sooner rather than later on the upside, and we are expecting 56,400, 57,000 from a short-term perspective. Having said that, 56,000, 54,100 is the stop loss level or the floor for the Bank Nifty. If 54,100 is breached, then this assumption of an upward breakout will be reduced. So 54,100 is the level, crucial support level for the Bank Nifty, and on the upside, 56,400 to 57,000 is our expected target.
All right, 54,100. That's the floor that the Bank Nifty, has, when it comes to the stop loss. But talk about an HDFC Bank. That stock has managed to outperform. How is the chart of an HDFC Bank stacked up vis-a-vis the likes of Kotak, even ICICI Bank for that matter?
See, the chart of HDFC Bank is more or less to similar to that of Bank Nifty. The major difference is that it has witnessed some more amount of correction. That is from around 2000, it slipped to around 1900 odd level. So that's a 5 odd percent kind of a correction. However, the Bank Nifty is consolidating. So overall, the structure still remains on the positive side. It's more or less of a range bound price action. And we believe that until and unless 1900 is breached on the downside, we are not expecting any major price correction in the case of HDFC Bank. On the upside, 2000 is the daily upper Bollinger Band, and that is the immediate resistance. So 2000 on the upside remains the level to watch out for, and on the downside 1900. Basically, a 1900 to 2000 point kind of a range in the case of HDFC Bank.
Okay, 1900 to 2000, those are levels to watch out for on HDFC Bank. But let's take stock of some of the auto names that are in focus. M&M reported numbers yesterday. The auto pack, was among the leaders, sectoral leaders in yesterday's session. We saw strong numbers coming in from M&M, big margin beat. Brokerages have also, in fact, given a thumbs up to the kind of numbers or performance that M&M has handed in for the fourth quarter. Quickly taking you through some of the brokerage views. Kotak Institutional has has maintained a buy rating. Target price is at 3,500. They've said that the company is firing on all cylinders. Outlook for FY26 has been extremely strong across verticals. And if you look at Jefferies, they have also maintained their buy rating. Target price, however, has been cut to 4,000 from 4,075. They've also taken note of the fact that the company has delivered 12th consecutive quarter of double-digit EBITDA growth, and they are expecting some around 12% volume growth and 18% core EPS compounded annual growth rate over FY25 to FY28. In fact, they believe that there is room for further re-rating with strong growth outlook and improving franchise as well. And it is one of Jefferies' top buys within the auto pack. But another stock that will be in focus from the auto pack would be Tata Motors. There will be shareholder voting on the company's proposal to demerge the business into two separate entities, one for the passenger vehicle and one for the commercial vehicle. Now, the passenger vehicle business will house the internal combustion engine, electric vehicles and JLR entities, and shareholders are set to convene at 3 p.m. this afternoon. In case the resolution is approved by shareholders, Tata Motors shareholders will be entitled to receive one share of the demerged CV business for every one share that they hold. The shareholders who had shares of Tata Motors as of March 28th will be eligible to participate in this meeting. If you compare these two charts, M&M and Tata Motors, which one is looking more attractive right now? Because Tata Motors has also seen a strong rebound from its 52-week lows.
Yeah, so if I look at it from a technical perspective, then M&M stands out. It's trading near all-time highs, and Tata Motors is lingering near all-time low. So definitely M&M has a better price structure and strength. So M&M would be the preferred pick. However, post this correction in Tata Motors, it has rebounded quite well. We believe that there is still more upside in the case of Tata Motors towards 720.
Sure. More upside on Tata Motors, but the chart of M&M is looking much better in comparison. But let's take a look at the market open then. First ticks are indicating a positive start, although it is a fairly mild start. In fact, the Nifty, is oscillating between green and red. But the mid-cap index continues to do well. It's up somewhere around 0.2% at the current juncture. Bank Nifty is also extremely flat. That's also trying to establish some kind of a trend. But right now, it's a little iffy. You can see the indices flitting between gains and losses. The advance decline ratio at the current juncture is in favor of gainers, 1200 advances to 600 declines. So it is 2:1 at the current juncture, but early days to really predict which way the market will head or which way the breadth of the market will head. But let's take a look at the sectors that are taking the lead at the current juncture then. Yesterday, autos were among the top gainers. Today, yes, autos are extending those gains, almost 0.5% gain on the auto pack. Pharma is down 1.5%. There is news flow that US President Donald Trump has signed an executive order to expedite production in the US. So that's weighing in on the pharma pack. 1.5% cut. Of course, Trump has signed the executive order to encourage U.S. drug manufacturing. That will be a negative, development for the Indian pharma companies, and which is why we are seeing a 1.5% cut on the pharma pack. In terms of other sectors, metals are on the back foot. Yesterday, metals were upbeat. The Nifty Metal Index was up 1% yesterday. PSU banks, however, are seeing a good pickup after a couple of sessions of weakness. 0.5% uptick on the PSU banking index. Want to see what the oil and gas pack is doing. That's also trading with mild gains. So all in all, most of the sectors are trading in the green, barring the metals, pharma, metals and pharma pack. So yes, it is an okay start in tandem with what GIFT Nifty was suggesting. So yes, we are holding on to that 24,450 mark, but still below that 24,450 mark. Quickly take a look at the top movers then on the index. M&M, another 3% gain. So in the last two sessions, M&M is up somewhere around 6.5%. ONGC is the other one that's gaining in trade. Hero Motocorp, Bharti Airtel, Hindalco, SBI Life, Trent extending gains. Bajaj Finserv extending gains as well, and some of the names like Nestle India, Tata Consumer doing well in trade. On the flip side, top three laggards on the Nifty are from the pharma pack: Cipla, Dr. Reddy's, Sun Pharma. Aside of that, you had Titan, that's also under pressure. Adani Ports was among the top gainers yesterday, under pressure today. Reliance Industries as well, some bit of cool off, but holding on to that 1400 level. Eternal under pressure today, and Sriam Finance once again back under pressure. Yesterday it saw good traction, but today it's back in the red. Let's talk about the pharma pack, Jatin. Cipla, Dr. Reddy's, Sun Pharma, all three are under pressure among the top Nifty laggards. Of course, there's been this negative development in terms of what President Trump has done. How are you viewing some of these large cap pharma names now? Cipla, Dr. Reddy's, Sun Pharma. Are these a good buy on dip candidate? Any of these?
See, in the case of Pharma Pack, it has been more or less underperforming in this recent rally, majorly because of the uncertainty that is lagging around this tariff announcement. So we believe that there is we should not be in a hurry to buy these stocks only because they have fallen recently. We'll wait for the clarity to emerge because post the announcement, there could be a knee-jerk reaction on the downside. So there is no immediate hurry to buy these pharma stocks as of now. Overall, structurally, yes, these stocks have weakened in the recent couple of trading sessions, even prior to this announcement. So Dr. Reddy's has decisively slipped below its short-term moving averages. So this generally occurs when the inherent strength is not there. So structurally, some of the stocks are a little on the weaker side even before this announcement, and they were lagging in the up move. So yes, no hurry to buy as of now. We'll wait for the announcement to come.
Okay, that's a view, wait and watch approach when it comes to pharma. But let's talk about another stock, Coforge. Good 4% uptick on the back of, in line to good set of numbers. Profit in line with estimates. Rupee revenue was slightly below, but margins managed to beat estimate at 13.2% vis-a-vis 11.9% on a sequential basis. The operational performance was slightly better than what the street was expecting. And in terms of the deal intake, it stood at $2.1 billion. That was at an all-time high. But the stock is down over 20% in 2025 so far. What is the take on a Coforge in particular on the charts, Jatin?
Yeah, so in case of Coforge, yes, we are pretty positive. It has witnessed a decent amount of correction, almost 40% from the highs. And we believe that this stock has formed a short-term bottom at the 6,000 odd level. Post this announcement also, we did see a positive opening, but however, the profit booking has come in. I believe that there could be some amount of consolidation going ahead in the case of Coforge. We are expecting levels of 7,500 to 7,400 on the downside. But however, this is one stock that we need to keep on our radar from a short to medium term perspective. Whatever declines we get post this result announcement should be considered as a buying opportunity. Overall, we have turned positive on the IT sector, and Coforge is one of the stocks we are our preferred stocks in the IT space. Coforge
Hmm.
is likely to witness a buying interest going ahead.
Okay, Coforge, keep on your radar, buy on dips. That's a strategy that should be there for a Coforge. But Indian hotels, numbers were pretty good. Profits saw a 25% uptick and revenues were up somewhere around 28% on a year-on-year basis. Margins were also higher at 35.3% vis-a-vis 34.6% on a YY basis. And this morning, the brokerage notes are also fairly positive, where Jefferies has maintained its buy call. Target price, however, has been cut to 980 rupees from 1000 rupees per share. They've said that the sector outlook is positive and they are expecting EBITDA PAT compounded annual growth rate of 16 to 18% over FY25 to FY28. But the stock is not seeing good traction. I think it's down somewhere around 3% as we speak. The stock has not been doing that well over the last 5 sessions as well, and on a YTD basis as well, it's down 11% or so. How do you really navigate this stock now? Hasn't really been doing much. If you look at the last 1 month as well, Jatin, any trend that's emerging on the charts of Indian hotels?
See, in the case of Indian hotels, the structure is more or less that of a consolidation pattern because 880 on the upside was the previous all-time high, and thereafter it slipped to 700. And since last, I think November 2024, so it's almost 6 months that it has been consolidating in this range. The ideal strategy to trade in such kind of a consolidation is to accumulate around the crucial support zone. Now, in the case of Indian hotels, the crucial support is placed around 720 odd levels, where the previous swing low or the weekly lower Bollinger band is placed. Around 720, one should start accumulating, and on the upside, when the stock approaches the 850 to 880 mark, that is the time around which we have to book profit. So currently it's trading around 770 and it's approaching 720. Around 720, one should consider buying Indian hotels. So there is a decent amount of
Hmm.
weakness that we can expect from current levels. Around 720 is the level to accumulate.
Okay, that's the view on Indian hotels. But with this, let's shift focus to all the viewer queries that are trickling in. There are quite a few, Jatin. You will have to address quite a few of them. But let's start with Sriam Finance. Naveen has a query on this particular stock. It has been under pressure ever since the results came out yesterday. It did see some bit of traction, but once again, it's down in the red. Any thoughts as to whether this weakness should be bought into, or how should one really navigate their holdings if they are invested in this stock?
Yeah, from a short to medium term perspective, you should hold on. I'm expecting a correction towards 580 in the case of Sriram Finance. It has seen a first leg of the decline, and thereafter we did see a minor pullback from 600 to 625 odd levels. This is only a retracement of the previous decline. This is just a minor degree pullback, and thereafter we will have one more leg of decline, which should take the stock towards 580 on the downside. From an immediate, very short-term perspective, those who are holding should utilize this opportunity to exit their positions. From a longer to medium-term perspective, 580 is the level around which we can expect buying interest to kick in again in Sriram Finance. That is our view. I think the risk appetite, if it allows them to hold until then he should continue to hold.
Okay, that's the call, Naveen. I hope that answers your query, but I would like to take up this query from Satya CK on Ethos. Wants to know whether there is scope for a fresh long here. Ethos reported its numbers; they were pretty strong, but the stock itself has been fairly sideways. If you look at the last 1 month, last 5 sessions, it hasn't really given out a clear direction. Does it merit a fresh long in this counter?
The trend for Ethos Limited is negative. I think it has not been able to surpass the 20-week moving average. It is forming lower tops and lower bottoms on the weekly charts. So on a higher time frame, the trend is weak, and what we are expecting is a retest of the previous week lows of 2,200. So decent 7 to 8, 9, even 10 kind of a correction is even possible in the stock Ethos. There is no uptrend signs of uptrend as of now. So if he's likely to hold or he has the risk appetite, then he should continue to hold. However, our view is negative on the stock.
Okay, that's the view on Ethos. I hope that answers your query. You want to take up a query on Bharti Airtel. This one's coming in from Bhumika Parekh. She has some 55 shares at the rate of 1624 rupees per share. Wants to know if she should book profit or wait for some time before doing that. And she also wants to know if there is a possibility of the stock hitting 2000 rupees. Your thoughts?
Yeah, see, this stock has a potential to rise towards 19. 69, that is around 1970 from a short-term perspective, which coincides with the daily upper Bollinger Band. Now she is holding from 1600 odd levels, I suppose. So she should definitely consider partial profit booking at current levels and trail our stop loss. So that is a mechanism in which one should ride the up move with limited risk on the downside. So she can take advantage of the up move and as well as also exit at a good price. So a trailing stop loss should be maintained at 1875 for our holdings, and on the upside 1970 is the immediate resistance. So these are the levels that should one should have in mind while trading in Bharti Airtel.
Okay, that's the view on Bharti Airtel. Bhumika, I hope that answers your query. I was just looking at another query coming in from Anunay. Wants to know your thoughts on BLS International, which he is holding at 407. Wants to know if he should book losses. This stock has been stuck in a downtrend. It's at around 350 rupees. He's making some bit of a loss. Should he average, hold on to it, or should he book losses?
See, BLS International, the trend is more or less of a range-bound price action. On the downside, we are expecting a retest of the lows of around 325. So there is a 25 rupee downside even from current levels. However, what immediately I am expecting is a bounce back or a counter trend rally towards 370 odd levels. So I believe that on a pullback or a bounce back to 370, he should square off his existing position at a minor loss.
Okay, Anunay, that's the view. Hope that answers your query. The next one's on Emphasis, coming in from Pankaj Kajalia. Wants to know your thoughts. Hasn't really mentioned a time horizon, but for the short to medium term, how should one navigate this stock? Because it did see a good up move in the last 1 month, a double digit up move, 15-16%. Although in the last 5 sessions it has cooled off a bit. So Emphasis, we spoke about mid cap IT and IT just a while ago, but particularly for Emphasis, if somebody wants to enter or holds this stock, how should they navigate?
See, if someone wants to do a fresh entry, then 2340 is the level that coincides with the 20-day average. So a dip, the overall trend is positive. I believe that most of the IT stocks have formed a short-term bottom. So we believe that 2340 in the case of Emphasis should be kept on the radar. 23 40 is the 20-day average. A dip around that level should be considered as a buying opportunity. On the upside, the immediate targets or the immediate resistance that we see on the stock is at 2640. So I think buy around 2340 for target of 2640 on the upside in the case of emphasis. If someone is holding, then continue to hold. Stop loss should be 2340.
Okay, that's the view on an emphasis. But we're running out of time. I would like to just squeeze in one more query. Let's take it up on a Voltas coming in from Pannu Anil. Here as well, he's not really mentioned his time horizon. But shares of Voltas, down 0.5% right now, and haven't done much in the last 1 month as well. But it's been a 30% cut on the share prices over the last 6 months. Stock has been under pressure. 1230, does it merit a look or is it an avoid?
See, as of now, it's an avoid because the trend is negative. It's forming lower tops and lower bottoms, and it will be reversed only about 1275. So, until and unless 1275 is taken out on the upside, the trend remains negative. On the downside, the crucial support is around 1130 on the downside. So, that's a 100-point cut even from current levels. Overall, we believe that the stock is still in a downtrend, so fresh entry should definitely be avoided. If one wants to enter, then on the upside, once the stock trades above or sustains about 1270, 1275, then this stock can be considered. However, at current levels, it's avoid.
Okay, avoid Voltas at current levels. Hope that answers your query. But before I let you go, Jatin, any recommendations for our viewers this morning?
Yeah, see, we are expecting a positive trading session, and hence we are recommending two long ideas. The first one is on CESC, that is Kolkata Electric. In yesterday's trading session, it has broken out of a 3-day consolidation on the upside, and we are expecting a positive price action, though it's mildly in the negative, but overall, over the or during the course of the day, the action might pick up. On the downside, 159 should be kept as a stop loss, and we are expecting 179 from a short term perspective. So, CESC is our first recommendation. The second recommendation is from the FMCG pack, that is Marico. So Marico has broken out of a 3-week consolidation on the upside. So that's a major breakout that we saw in yesterday's trading session. So Marico should be bought with a stop loss of 700, and we are expecting 755 from a short-term perspective.
Okay, Marico CSC, two long, ideas coming in from Jatin. With that, Jatin, would like to thank you for taking out time and helping us out with our viewer queries as well. I look forward to more interactions in the future as well.
Thank you so much.
Thank you. And to our viewers, if we couldn't take up your queries, please don't worry, keep them coming in. We will try and take them up tomorrow if we missed it out today. But markets are extremely flat, no clear direction as of now. The Nifty is just about clutching on to that positive territory. 24,467 is where the Nifty is at. But on that note, let me bring on board our next guest for today. Joining me is Big Market Voice, Big Market Expert, Sunil Subramaniam. Sunil, lovely to be chatting with you once again. Last time we spoke, I think we were, just about starting to see recovery take shape. Now we are back near that 24,500 mark, and FIIs have also returned. But tell me something, we have the border tensions escalating, geopolitical tensions, at the center stage. Even then, FIIs continue to pump in money into the Indian markets. Do you think it's the TINA factor? There is no alternative factor that is driving FII flows. What is it? Because recovery across global markets is also taking shape with S&P, just last Friday clocking in a 9-day winning streak. It's best in 2 decades.
So I think that first of all, there's a positive move towards equities. As you said, the American markets are also showing a recovery, and FIIs are increasingly willing to take up risk and bet on equities. So that's the overarching thing that we are seeing. And what's the reason for that? I think the reason for that is the pragmatism which has come about in the Trump policies on the tariffs. the way. So if you see now, we are now near the end of the tunnel in terms of at least non-China getting a clarity on the tariff scenario, how it will affect both the US economy and corporates in the US as well as on the suppliers, right? So I think Mr. Scott, who's the trade secretary there, mentioned that they are close. At least a dozen countries are have reached out and are in advanced stages of signing a deal. And Mr. Trump himself mentioned India, so coming to India there. So I think that once they see the clarity, right, wherever it ends, as long as there's an agreement between a country and America on that, to that extent, there is a way forward. So I think the markets are pricing in that. The India factor, you mentioned it as a TINA factor. So I would say that look at it this way. The TINA tends to be as if they have no other choice in terms of negatives, and this is India's the best hope. I'm not sure it's that. The word TINA tends to refer to that. So I would like to say that actually the situation is emerging very positively for India. So it's actually an active choice for them to choose India, and I'll lay out the reasons for that. I think top and center of everything, right, is the oil price fall. And I think with Saudi Arabia indicating even more production increases, and there I'm reading articles about how it could slip below 50. It's not yet, the futures are not yet indicating that.
Yeah.
But I'm just saying that overall is an overarching thing for short-term FIs to come in, right? I don't think longer-term FIs have ever had an issue about India's growth. All that is not new news. The second aspect I would say is that on a sequential basis, right? If you see the GST collections, right, in India, coming out stronger, 12% stronger compared to the same period last year, indicates that the economy is recovering from the lows it saw in the Q3 and Q4 of last year. So, which means that you're now buying into a rising economy. The market earnings are still mixed, but sequentially, I'll tell you where the issue is. If it's sequentially improving, it means that you're going to see the future quarters come in better. So I think that's the second take for India is concerned, that the domestic economy. And the third is, I think, a supportive RBI policy has made it very, very attractive. The reason being that there's 5 lakh crores of liquidity the RBI has pumped in. There are 2 rate cuts and possibility of a third. And on top of it, you have inflation supporting this factor. So if you have a supportive RBI policy, then the FIs are reading into the fact that domestic equity investors will probably start allocating more. Actually, if you see, DIs are still sitting on the fence because they are waiting to see the earnings season fully play out. So there's still cash in the bank for the DIs who can come in. So FIs are probably looking at it and saying, if these things play out, the DIs come in, then the prices could go a bit higher. And if you see India's valuations there, a long-term average premium to the emerging markets is about 62-63%. We are trading today at 75%, but we were at 90, close to 100% few months ago. So I think that we are that space where we are not cheap, but we are round about the long-term average. And they are now sensing that India may not get cheaper because domestic money will start flowing in and maybe takes prices higher. So might as well buy into a market we intend to be invested in a bit early, though the valuations don't truly justify. Now, coming to the effect of the Indo-Pak situation that you mentioned, why are not FIs worried about it? It's because two things are there, right? I think the government has demonstrated a very diplomatic, pragmatic approach to handling the crisis. Well, there's been a lot of talk about aggressive action and all. The government has restricted itself to building a good diplomatic thing with talking to the UN, talking to the US, talking to Europe, and everybody trying to build a consensus around it. Second, they're acting economically, right? Even going to the UN to try and see if UN can do something. So I think the way it's being handled, as long as it's not a full-fledged direct upfront war, right? The FIs will be relieved because they know that there's too much at stake for India in this emerging situation, right? So we want to actually give employment to our people. We have the largest amount of workforce waiting to be employed. We have far greater challenges to decide on, to take action, and be doing a BTA with the US, and all these are probably top of the agenda. So they are sensing that India is going to handle this in a balanced, mature manner. Yes, there will need to be strong action. The government will do that. But what they are saying is that if that happens, it's still something that will be quick and dirty. It could be a surgical strike. It could be an attack of the type that the Balakot they did. They just go in and come out. It will be something to demonstrate that India will not take this lying down. but not a prolonged war like the Israel-Hamas war or the Russia-Ukraine war. They don't see that happening in India. So as long as that's a short-term thing, they feel that they can take it in their stride. In fact, if there is a correction because of such an event, FI buying would step up even more because they're getting India cheaper. So I think that they are all taking a slightly medium-term perspective that India as a nation is not run by any tin-pot dictator who is going to take a knee-jerk reaction to this situation, but will take a strong, solid action, but which will be by and large within the comfort zone of the international community. At the same time, trying to find that balance that the domestic population also feels that we have acted strongly. It's a balancing act. We don't know how it's actually going to pan out, but I think the confidence that this government will pull that off is what is probably giving FIs the comfort that let's not wait for the whole uncertainty to go on. Let's start allocating gently into India.
All right, that's a very comprehensive explanation, and it puts to rest a lot of other questions that I had for you, Sunil. But let's talk about the recent Supreme Court ruling on JSW Steel in terms of the Bhushan Power resolution. What kind of implications will that have going forward? Has it shaken the confidence in the entire IBC process? How are other cases being impacted, and what does it really mean for JSW Steel as a company? I want to get in your thoughts on this entire issue.
See, I'll tell you that. See, I think that one has to bear in mind that that's the democracy at play, where the judiciary has a say on this. So I think that in this tussle between a parliament which wants a strong IBC to be implemented and the judiciary which is trying to look at the rights and the wrongs, right? There will be this tussle, right? And you'll have one evidence, one decision going this way, one that way. I would not try to take this and draw a parallel to say all IBC cases are now under threat, right? I think it's all specific to the event. But I think this is the great strength of India, that you have a counter-check balance of a judiciary which is impartial and takes decisions. You may agree with the decision, not agree with the decision, different, but it strengthens the process. So tomorrow is as a decision where the Supreme Court actually, let's say, supports another IBC case. It means it's passed the test and the filter. So view these as the challenges of putting through a very hard and difficult law which is trying to resolve it, but there are these challenges that come up because we have an independent judiciary, and you have to take the good with the bad. Just because if one thing is turned down, you don't go and dump the whole thing. You don't throw out the baby with the bathwater. I think we have to look at it, resolve it. I don't want to go into company specific on this because that wouldn't be right of my part, but overall to me, right, while this may seem like a setback for the IPC process, I don't view it as that. I think it is an important that when we take such decisions, we have to take the other points of view that a judiciary may come up with also in terms of framing it. So it's just a learning. It's part of the learning curve for us as we grow into becoming more of a developed country, that the stakeholders in this, the judiciary is a part of the stakeholders, is something to recognize. So I would like to look at it in that perspective and not simply do a knee-jerk reaction to one particular decision by the judiciary.
Fair point, Sunil. Let's talk about the earnings season then, particularly the banking pack. Of course, in terms of liquidity, the RBI has been extremely hyperactive, so to say. In terms of earnings particularly, of course, the rate cut cycle is at play. Most of the experts are expecting another 50 basis point rate cut in the current fiscal. SBI, the big elephant, so to say, has hinted that, of course, there will be margin pressure. They've also scaled down their loan growth guidance. But, on the other hand, you see private sector players like HDFC Bank, ICICI Bank handing in great set of numbers. Kotak, on the other hand, has its own set of issues in terms of MFI stress. So, after the report cards from some of these companies, which way should one tilt? Should one stick to the private sector names? Do you think they are better equipped to deal with margin pressure as a result of rate cuts?
So I would say yes, to give a short answer, yes, but let me talk about the justification for that. So if you look at it now, you talked about how SBI had given a kind of a down guidance for the future, whereas the private sector banks seem to be better placed there. So I think the reason for that comes from the fact that where do you see the whole banking system, right? And when I say banking system, let's talk about the overall BFSI system being driven over the next few weeks and months. So the first thing is that, yes, rate cuts are on the anvil. So rate cuts will mean that banks which have a lot of fixed rate loan books. Now, the housing loan book is largely variable. It's the personal loans and the auto loans, which are of the 3-year tenure, which are the fixed rate loans, which will get hurt because you will be dropping interest rates on your deposits, but you won't be able to have any effect. So the private sector banks, right, when they drop interest rates, they will still be earning the fixed rate on their personal loans and the auto loans. So the margins will be less affected because they have a greater play in the retail lending, except for the home loan part, which is variable. The rest of the retail lending by and large is fixed rate. So I would say that in the short term, the rate cut would benefit the private sector banks because they have a fixed rate loan book, and they will pass on these rate cuts in the deposits and probably have lesser impact on their margins as compared to a public sector bank, which is mostly in the corporate lending space and the housing loan space, which are variable rate where there could be margin pressure. That's one reason to favor the private sector. The second reason for that is, where do you see the nature of the loan growth coming from, right? Like you said, SBI has slightly given a down guidance. So the issue is here that where's the loan growth going to come from is in a drop in EMIs, one. Second is the 100,000 crore of tax giveaway filtering through into the hands of the middle class consumer, right? So as his salary from April month, May month onwards, he feels the benefit of the tax cut, and an RBI rate cut comes in and reduces EMIs. The loan growth will build up, right? That's the demand side. And there again, private sector banks are much better placed to exploit that with quick turnaround, instant approvals at the consumer durable counters, whether it's a Chroma or a Reliance Retail, where you sell these products, right? The quick turnaround. So I think that they will get a better loan growth book. Yes, the fact that you are going to have to reduce EMIs means that they will have to proportionally cut the deposit rates, but definitely they cannot cut it as much. So there will be margin pressure. I'm not denying that, but I'm saying they can compensate with a faster loan growth book because it's price into quantity, right? You will have slightly lesser NIM, but your loan growth in the private sector could be better. Hence, the P into Q could turn out into an EPS growth, earning coming out better than guidance. That's the second part. The third part is the fact that most of the private sector banks have a very good fee-based income out of the mutual fund distribution, AIF distribution, insurance distribution piece, whereas in the public sector banks, apart from a state bank and maybe a Canara Bank and to some extent a Bank of India, none of the public sector banks are yet that big players in this whole space of distribution. So I think that of the 100,000 crores, you will see a significant proportion also go into incremental savings, which could boost the fee-based income of the private sector banks as compared to the public sector banks. So from a near-term perspective of the next 3-6 months, I do believe that private sector banks represent a better play for the time being. If you have a long enough term of an 18-24 month, I see that somewhere this consumption, which I expect to be a driver, will boost capacity utilization, and corporate capex could pick up by the end of the year, next year, which public sector banks take. So your time frame also plays a part in this in terms of how you allocate between private sector and public.
Sure. Very, very comprehensive answer there, Sunil. But last question really, due to paucity of time, what should a portfolio really look like at, this time? Of course, there are rising geopolitical tensions. Gold has, been hitting record highs recently. So what is the kind of portfolio construct one should have to get the best of both worlds, equities and commodities?
So I would say that if you look at it, to me, the two M's are the key play in the mutual fund space, which is multi-cap funds and multi-asset funds. Okay. Now, why do I do it this way? Is because when you take multi-asset funds, I think the regulations permit up to 20% in commodities. So I think there are AMCs which are taking full advantage and keeping 15 to 20% in commodities, and naturally gold forms a significant part. So buying it through that means that you can get the gold through an equity taxation matter. But most of these multi-asset funds, when they put into the equities part, they tend to be in the large cap side. So what you will miss out there is a broader market equity participation, but you get a good blend of equity because you'll have about 10% only in fixed income. So you'll good blend of equity and gold in the multi-asset. So by choosing then a multi-cap fund as your other portfolio, you get a minimum of 25% into small caps, 25% to mid cap, and 25% to large caps, and the balance based on the fund house can switch between the two. So if you combine these two, you will get not only a broader market equity exposure, but you will also have a good exposure to commodities in that. And I think that's the best way in the current scenario to play it. And if you're a little more conservative, then maybe you look at a balance advantage also. But I would say multi-assets itself should be able to take care of the risk reward in a better way.
All right, that's the word then. With that, Sunil, I would like to thank you for taking out time as always and joining in and sharing your thoughts with us. Love to get your perspective, and I look forward to more conversations in the coming days as well. Have a great day.
Right. Thank you. Same to you.
Thank you. Well, on that note, we've come to the end of this edition of Opening Bell. Just want to see what the market is doing. Now, we've slipped into the red, although no big cut, so to say. Trading with a negative bias, the Nifty around that 24,420 mark as of now. Sensex down 100 points, and the mid-cap index, there the cut is a little deeper when you compare it with the benchmarks. 0.5% cut when it comes to the mid-cap index, and the bank Nifty also trading in the negative zone. So yes, we have turned negative, and the breadth is also now skewed in favor of the losers. Let's see how things really pan out from here. But of course, we'll be back with closing bell at 3:30 p.m. Don't forget to tune in for that. Till then, have a great day, and stay tuned to Money Control for all your news and updates. 10 a.m. is when Ather Energy lists. The shares are expected to see a flat listing. The IPO garnered a fairly muted response, a subdued response, so to say. It was subscribed somewhere around 1.43 times, and the demand was largely driven by QIBs and retail investors. So keep an eye out for the listing of Ather Energy. With that, thank you, and I'll see you at 3:30 p.m. Have a great day.